Good morning, everybody. Welcome back to Strongman Personal Finance. We have a sponsored video today. Yes, this is the second time I have been asked to make a video on RCI Hospitality Holdings Incorporated. Rick, what is this stock? Well, basically, they own a bunch of clubs where women dance in various stages of undressing. Is that okay, YouTube? You gonna get mad at me? And they own some restaurants called Bombshells, which I'm sure you can imagine what is at those restaurants. Anyway, let's go ahead and check out RCI Hospitality Holdings again. Now, specifically, the person was asking, why is the stock going down? Is there something concerning? At the end of the day, stocks are going to fluctuate, okay? If you want to buy individual stocks, sometimes they're going to go up, and then you're going to feel like a genius. Sometimes they're going to go down, and you're going to feel bad. But at the end of the day, if you're buying a solid company, in the long run, you should hopefully be rewarded for that. Now, we can see that RCI Holdings over the past year is down 6%. Year to date, it's down 30%. So if you had bought it up here, you're probably down pretty significantly. And you may be asking, oh, well, is the stock ever going to recover? Nobody really knows. That's the crazy thing. Nobody actually knows. And if somebody tells you, oh, yeah, it's going to come back, well, they're probably a fraud. Anyway, let's go ahead and look into this stock. Market cap, $620 million. Revenue, $289 million. And net income, we see they have positive net income. The company makes money. That's good. We have a dividend, a very small dividend, which I actually like, because the more of a dividend the company pays, the more taxes you're going to pay, and the stock price drops by the amount of the dividend. Yes, it's true, dividend investors. So overall, we have some, at least nice things on the surface. It's profitable, it pays a dividend, and it's got a price target, according to the analyst, of 125, which is basically a double from where it's at right now. Now, let's go look at the history of the financials of this company. We've got revenue by revenue has massively exploded, especially starting in 2020. We can see it collapsed during the lockdowns, and then it shot up massively. This company acquires a lot. This is a acquisition company. They buy clubs where women dance. Oh, I love YouTube now. But they've definitely grown their revenues, a big part of which is due to acquisitions. So we can see revenues are going up. If we go down to margins, we can see they have an insanely high gross margin. Basically, how a club where women dance works is they want to get you in. Once you're in there, you're going to throw money at the women. And you're going to spend a lot of money on booze, and you're going to pay a lot of money on food and ATM fees. I know that because I used to go to these all the time. And they make all the profit from that, okay? It's basically they want to get you in there to buy booze and buy food, et cetera, et cetera. So the margins are very high. Very, very high. And men don't care because they're in there and they get to see stuff that they really enjoy. On a side note, if you want to join an exclusive community and get access to Christopher Bell, that's right, me, Strongman Personal Finance, check out the pinned comment below and join our Discord community where you can ask me questions directly via text, and if you sign up for the highest tier, you can actually meet me in person every 2 weeks. So check out the pinned comment. Join the Discord community, and let's make some money with index funds, of course. Cheers! So we can see that this company has a very high gross margin. Their operating profit is pretty good, and it hasn't really gone down significantly. Their margins haven't compressed massively. They are a little bit lower than the last couple of quarters, but overall, if you look at the average trend of their operating margin, I don't see a massive collapse in operating margin. And then we look at their profit margin. Yeah, it's definitely within the range that it normally is. So we don't see a collapse in profits, which is good. You want the company to stay profitable. And you want to watch out for if margins start to get constricted going into the future. I don't know how, because I mean, men are gonna pay a lot of money to see you-know-whats, but whatever. And then we have free cash flow margin, which is also within the realm of normalcy. Now, obviously, free cash flow margin is going to fluctuate because if the company makes an acquisition, that's going to be an expenditure, and you're going to see the margin go down. So it'll fluctuate. But overall, this company is profitable with positive operating cash flow, and they're growing revenue while basically maintaining margins, which is a good thing. So that's what I see overall. When it comes to shares outstanding, they have issued shares a little bit recently, but it's nothing insane, okay? And even if they did issue shares, let's say the stock price runs up and they issue shares to acquire some more clubs, I don't necessarily see the problem with that, especially if the stock is, quote unquote, overvalued. So I don't see any massive dilution here. Now, let's go ahead and look at the balance sheet. So we can see that the cash has dropped recently. Why is that? Well, we'll find out in a second. They could have bought more property, plant, equipment. They could have had some kind of acquisition. We don't know, but we can see the last 2 quarters, or at least, the last 2 quarters the cash has dropped pretty significantly. Not necessarily concerning depending on what they spent it on. Same thing with cash and cash equivalents. Receivables, this is money that's owed to them, has, steadily trended up, which it should be with revenue. Inventory has gone up. This is probably their food and booze that they're selling. And they have total current assets of $40 million. Let's compare that to their current debts. So here's the first thing that's a little concerning here. It doesn't necessarily mean they're going to go bankrupt, but it is something that's not necessarily good. They owe $52 million within the next year, and they currently only have $40 million of current assets. Now you may ask yourself, oh my God, they're not going to be able to pay their bills. Not necessarily. I mean, they're a positive cash flow company, and if they really need to pay a short-term bill, they can just borrow money some other way and use that to pay the current debt that's maturing. But we can see about $26 million of current debt is maturing, and they have more current debts than current assets, which it's good to keep in mind. I don't think this company is necessarily going to go bankrupt. I don't see imminent collapse, but you want to keep that in mind, okay? Next, we have long-term assets, property, plant, equipment. So we see that a good chunk of their long-term assets is either in goodwill or intangibles. Let's actually go check their balance sheet real quick. Let's see. So it's actually a lot more in intangibles than goodwill. I don't necessarily like seeing a company with a ton of assets in goodwill. Goodwill is just when a company acquires another company and they spend more than the value of the assets minus liabilities that they're buying. It's basically a plug in a journal entry where a company has overpaid for assets, not necessarily for a bad reason, but they've paid more than the assets of a company they've bought are worth. When I see a lot of goodwill, it's concerning because if the company they acquired suddenly goes to crap, you're going to see that amazing big asset go down significantly on the balance sheet, okay? So overall, the goodwill isn't a huge part of their long-term assets, but they do have a lot of intangible assets versus their total assets. Now, we compare long-term assets to long-term liabilities. It doesn't look that bad, okay? Even their long-term debt is less than their tangible assets. So this isn't the worst balance sheet that I've seen. They're not underwater when it comes to their tangible assets. We go down and we see common stock. Okay, we can see they've issued some shares to raise money. We can see retained earnings has gone up. This means the company, every time it goes up, that means the company profited during that most recent quarter. And then we see shareholders' equity is going up and up and up and up and up. So overall, not the worst balance sheet in the world. The only thing that really catches my eye is their current ratio is a little concerning, but I don't necessarily think this company is in a position where they're going to go bankrupt. But that is something to keep in mind. So next, we're going to look at cash flow. So let's look at operating cash flow. It's increased. That's good. So they have positive cash from operations. They are making money from their operations. They have capital expenditures. We can see they're spending money on property, plant, equipment. Acquisitions, okay? You can see every once in a while they make a big acquisition, especially at the end of, looks like 2021. They had a big acquisition. And then they had another acquisition, looks like in the first quarter of 2023. You can see on their 10Q what their acquisitions were. We can go look at it in a second. But this company does expand by buying. And you can see that the revenues for the company started to explode right after that acquisition, that big line going down at the end of 2021. So while they may have organic revenue growth, they also are growing their revenue by buying other companies. So keep that in mind. Okay. So, positive operating cash flow, that's good. They have positive, consistent free cash flow. I don't see a massive problem with that. Dividends paid. Okay, they're increasing their dividend if that's what you want. Let's see. So, it says they're buying back shares. That's interesting. I need to go look at their... This may be wrong. Because here it says they're buying back shares. Maybe on a net basis they actually are. And then debt paid. So overall, I mean, they've packed on some debt. But like I said, their overall balance sheet is not bad. Their overall income statement is not bad. Their overall... basically, I don't see any major issues with any of the financial statements. Nothing that screams, oh my God, this is a pending catastrophe to me. But hey, you never know. Things can change in the future. So PE ratio, if you like valuations, it's, you know, probably lower than it's been in the last couple of years. Price to sales, it's selling off. We can see that. Price to books. So the company, theoretically, over the past 2 years is just on the surface cheaper than it's been. Doesn't necessarily mean it's a buy. Price to operating cash flow. Price to free cash flow. Well, it's actually hard to see in this chart, which is annoying. But overall, I don't see any major red flags. No major red flags. Doesn't mean you're going to have an insane positive return, but it's not the end of the world. So, like I said, the quick ratio, this is a stringent test of comparing current assets to current liabilities. It went down because they spent a lot of cash. They spent a lot of cash on an acquisition. So, their cash versus their debts, their cash and cash equivalents versus their debts is not as good. But based on this company's profile, I just don't see it going bankrupt. Personally, within the next year at least. But you never know, okay? So let's go ahead and check out this company a little bit more. So this is their most recent 10Q as of June 30th, 2023. We go down and they reported their financial results. What I want to focus on, since we already looked at the financial statements, is their management's discussion and analysis. This is the management kind of breaking stuff down in more detail about what's been going on. So we can see that they have 70 establishments that offer live adult entertainment. They buy more. And they also have this restaurant called Bombshells, which we're going to look into, which actually isn't doing that hot. Okay. So let's see. Let's go down a little bit more. Disaggregated revenues. This is what you want to look at. So this is going to tell us how much revenue they're bringing in by category. So you can see where they make their money. Sales of alcoholic beverages, that's increased year over year. Sales of food and merchandise has gone down. That's something to keep in mind. And service revenues have gone down a little bit. But let's see. As a percentage of total revenues. So we can see we already know they have high margins. They make a lot of money from their alcohol and food at the clubs because drunk idiots will pay a lot of money. So let's look at the actual revenues themselves. So sales of alcoholic beverages at nightclubs year over year, comparing this quarter to last quarter from the prior year. Alcohol, they're growing their revenues pretty healthily there. Okay, they're making money on alcohol. Sales of food and merchandise has gone up a little bit, and then service revenues has gone up as well. Now, this is at the nightclubs, okay? But there's a problem. You have this Bombshells. This is their restaurant where there's women in probably scantily clad clothes. Alcohol sales are down. Sales of food and merchandise are down, okay? So you can see the nightclubs are doing great. They're growing their alcohol sales. They're growing their food. They're growing their service revenues. It's really Bombshells that's kind of lagging a little bit. Personally, at least from my personal opinion. I guess you can think something else. But Bombshells ain't doing too hot. Doesn't mean it's not going to change in the future, but you can see that there are not some positive signs coming out of the Bombshells. But thankfully, the vast majority of their income comes from nightclubs, okay? And if the nightclubs continue to grow strongly, I think this company is going to be fine overall. So really, that's kind of my thoughts. There's really not much more to it. I mean, they're doing fine. I don't see any major red flags with this company. Doesn't mean the company's going to 10,000x. I can't tell you why the stunk is going down. I mean, it just happens sometimes. Maybe it just went up too much and now it's selling off, or, maybe there's something that I'm missing that the market is seeing that's really concerning about this company. But overall, I mean, the stock is still up pretty significantly since the pandemic. So I hope you enjoyed the video. Don't forget to check out the Discord and the Patreon, and I'll talk to you later. Cheers!